everyone, and welcome to our last monthly review of the economy for this year. This month, we'll focus on two things. Number one, we'll decode the GDP data for the July-September quarter of the current fiscal year. And number two, we'll look at the monetary policy announcement that was recently made. Talking first about the GDP growth at 8.4% in the second quarter was not a surprise. The high frequency indicators were already showing that economy was on a swift recovery path. There were some hiccups from the supply side, high commodity prices, but they did not stop the economy from logging above 8% GDP growth. Second, I think the point is that COVID-19 was largely under control. The economy was opening up. As a result, the services sector, which was lying low until now, also made a comeback. And then finally, I think the global growth was very supportive, and this helped our exports grow. So all these factors together led to a faster than expected GDP growth. Second point that I want to make is that the growth has been strong, the recovery has been strong, but it's quite uneven. The investment momentum is somewhat better than the private consumption momentum. The government's support to the economy in terms of its consumption spending did wane in the second quarter. Also, I think imports are rising faster than the exports. That means that the current account deficit is going to expand this year. As far as the outlook is concerned, we have retained our growth outlook at 9.5% for the current fiscal year. For the next fiscal year, we expect 7.8% growth. Omicron is a wild card at this juncture, so fingers crossed on that. I have three takeaways from monetary policy that was announced on December 8. Number one, RBI is trying to give a broader message that growth is a bigger risk than inflation at this juncture, and that is why they have kept the interest rates unchanged, policy stance as accommodative. They have also left growth and inflation forecast as they were in the October policy. The second takeaway I have is that this, however, should not be construed as meaning that that RBI is not normalizing the excess liquidity in the system. They announced three very specific measures for doing that. Number one was they have increased the size of the upcoming VRRR auctions. They have also provided banks an option to prepay the funds that they had raised under TLTROs. And they have also reduced somewhat the funding availability under the marginal standing facility. All these are aimed at taming the excess liquidity in the system. The third takeaway I have is that RBI may not have the leeway to stay pat in the coming months for two reasons. I think one is that there is inflation risk, particularly from the core inflation side. Second is that the global environment is turning a tad unsupportive for domestic monetary policy. US, which is the systemically most important central bank, I think is going to raise interest rates and normalize liquidity much faster than was expected earlier. So in light of all this, we expect the RBI to raise the reverse repo rate in February policy and raise the repo rate by 25 basis point in the March 22 policy. Well, Omicron is an unknown risk, and what it means going ahead is that monetary policy will be highly data driven, and we have to keep watching for the signals emanating from the economy. That's all for this month. Thank you very much for tuning in. Looking forward to sharing new insights in the coming year.